Ladies and gentlemen, Greg McCloskey from ForexLive.com. This is a Kickstart video for January 31st, 2024, last day of the trading month, where I take a look at three of the major currency pairs, the euro versus US dollar, dollar versus yen, and sterling versus US dollar. So let's get started. We had the unemployment cost index for the fourth quarter come out a bit weaker than expected at 0.9%. It's nice to get below the 1% level, but if you look at pre-COVID as a point of warning, all the employment cost index numbers were all below the 0.9%. So we're just coming back down toward that after multi years where the indices above the 1% level. So good news in the trend, bad news in that we're still high relative to the history, but nevertheless, we are seeing yields down as a result. The 10-year yield is down around 4.6 basis points, but stocks are also sharply lower. We're getting into the meat of the earnings, and with Microsoft, AMD, and Alphabet reporting yesterday after the close, markets aren't taking those their releases too well. Some of it may be that the things like Microsoft are traded at record high levels going into the report, and just didn't knock the cover off the ball. AMD discussed how AI was better, but their other businesses looked a little bit not so great. So that share is down sharply, and Alphabet also disappointed a little bit. So that is weighing with the Nasdaq index down about 170 points. The S&P index is down about 23 points. These are off high levels, however, so not too alarming. Nevertheless, it's something to be watch, and especially with other earnings coming out after the close. And then tomorrow we have Apple, we have Amazon, and we have Meta all reporting, with Apple being probably a little bit worrisome given the talk about iPhone sales not being up to snuff. With that all said, let's take a look at the euro versus US dollar. We are seeing it move to the upside here, dollar lower, maybe helped by the employment cost data. Also, technically, what we did see in trading today, we're looking at the 4-hour chart, is that the low price today held against the high of, or the low of the swing area defined by the number of different swing lows and swing highs coming in through this area, this yellow area right through here. The price moved back down toward that area in trading last week and found support buyers on each of the dips. In trading this week, we did break below the low of that swing area, but found support buyers against the 50% midpoint of the move up from this low going back to the October to December, that trading range. And we bounced off at that level again trading here today. The low price did find support buyers against the 1.0803 and pushed to the upside. We are now back above the 200-day moving average. That's this green line right here. Recall from trading not last week, but the week before, the price did find support buyers against that level and push higher in trading last week. We did fall below it on a different number of different occasions there. And in trading this week is the week started at this dash line right here. We've been trading above and below it, including trading yesterday above and below it, and on Monday at the start of the trading day we were above it as well. So with the price now back above the 200-day moving average, the hope is that the price does remain above that level when we start to rotate toward things like the 38.2% retracement of that same move to the upside here. Also, the 100 bar moving average on the 4-hour chart and the 200 bar moving average on the 4-hour chart were all the targets on the top side for increase, with an increased bullish bias. That is all dependent upon staying above the 200-day moving average. That's our close risk for traders today. Now that the bias has shifted again to the upside, we are still in this up and down trading type range type of market. Let's take a look at the dollar versus yen next. And along the theme of ups and downs, the trading range this week has initially moved to the downside, then moved higher. Traded above and below the 100-hour or 200-hour moving average. It's green line chart, 100-hour moving average. Also the 100-day moving average, but then rotated to the downside and back up and back down. The most recent move is back down below all that cluster of moving averages after trying above it. So that tilts the bias more to the downside. Here, again, all the employment cost data came in a little bit weaker than expected, so that is helping to push the dollar a little bit to the downside. Staying below the 100-day moving average, the 100-hour moving average, 200-hour moving average keeps the bias more to the downside. we just have to go with that idea from a technical perspective. If we believe in technicals, and I do, but we do, we have to also consider the ups and downs that we're seeing in the market, and we'll see how that all pans out. By the way, we do have the FOMC rate decision later on this afternoon, which is going to be a big influence in which way we go. So I was a bit remiss in not mentioning that earlier. So going forward, if the price were to move back above the 200-hour moving average off of a more hawkish Fed, we would see the price head up toward the underside, this trend line right through here, which comes in, let's see, around the 148.04 level. If we move above that level, we look toward this swing area up through here between 148.45 and 148.59, and then we start to look toward the high price of 148.80, which was reached not last week but the week before. Get above that level and opens the door for further upside the momentum. On the downside, this swing area between 146.96 and 147.06, let's call it around 147, would be a level to get to and through on the downside to increase the bearish bias. This level was defined by a number of different swing lows through here, which formed this bottom. Yes, we had a break to the downside here, but that was short-lived, and we reestablished support against that level. So get below the 147, 146.96 level opens the door for further downside potential in this in the dollar versus yen, and then we look down toward the low price that we saw in last week's trading up here around the 146.65 level. Let's take a look at the sterling versus US dollar next, and the story remains the same for this currency pair for sure. The price action has been largely in this range, with prices moving above and below the 100 and 200-hour moving averages in between. In trading today, we are seeing the sterling versus US dollar move back above the 100 and 200-hour moving average again. Dollar selling off of the employment cost data, and that is increasing the bullish bias. It's also back above the 38.2% retracement of the move up from this low right here, December low, to the high price that we saw in December as well. That level comes in at 127.01. So this is a barometer for more bullish above and more bearish below. In trading yesterday, the price did fall below the 50% midpoint of that same trading move. Higher in December, the price had been below it here, but we did hold support on previous lows here, and even here before breaking to the downside, but that was short-lived, as you can see, and we reestablished support against that 50% retracement in trading here today. So there you have it, a look at the three major currency pairs. We do have the FOMC rate decision. We had the ECI data come out weaker, and we have a volatile stock market and stock earnings. So lots of news on the horizon. Not to mention the employment report on Friday. Oh, boy. Anyway, my name is Greg Michalowski. Good fortune with your trading. Bye-bye now.